Hello everyone. Welcome to this session on insurance companies and pension plan. As a part of our understanding of various financial intermediaries or financial organizations who play different roles in risk management, we have already understood the role of banks in risk management. Now we are looking at what could be the role of insurance companies and pension plans as a part of the risk management process. So we will look at what is basically the concept of insurance. We will identify different kinds of insurance companies and their key features. We will spend some time very quickly in terms of understanding different policies that could be there as a part of life insurance and property casualty insurance, which are two major categories of insurance altogether. Then we would get into understanding different kinds of risks that are faced by insurance companies. What are they doing to mitigate those risks? Common kinds of risks that are associated with the insurance companies. Then, talking specifically about the life insurance, what are these mortality tables and what is the role that is typically played by mortality tables in the determination of the insurance premium? And as an addendum to that, we'll take a small example to try to get into the calculation of the insurance premium. Then, moving on from a life insurance to property and casualty insurance, we will be looking at some kind of ratios that are commonly calculated by the P&C companies to assess their performance from a financial perspective. So, are they making some kind of profit associated with some kind of policies? So which profits, which policies are giving them the profits and which policies are loss oriented? So some such kind of understanding we can do by doing some of the basic calculations of the ratios. Then we will try to bring in the concept of moral hazard again, the one that we have discussed during the banking understanding. We will try to bring in this moral hazard and what is the kind of role it has in the insurance. Apart from moral hazard, we would also look at the other concept called adverse selection. What is the difference between these two, and what are the two? What are these risks that the insurance company is getting into? What are the losses that the insurance company is getting into because of these two practices? Then we will also look at two major risks that are exclusive to the insurance business. One is the mortality risk and the longevity risk, and what is the kind of relation that is associated between these two kind of risks, and what are the kinds of mitigation activities or the hedging mechanisms that are available to reduce both the longevity or the mortality risks. Then coming to the next part, which is the capital requirement, right? How is the balance sheet typically done for insurance companies, and that too for life insurance companies? What would be the typical structure of the balance sheet, and property and casualty companies, what is the general structure of the balance sheet? What is the kind of capital that you find in the balance sheets of these two kinds of companies? Then bringing in the perspective of the regulatory system for the insurance companies, how is it different from the banks? What are the key differences that you find in the regulatory aspects between the insurance companies and the banks? We are going to have small discussion on that. And towards the end, we'll spend some time in terms of understanding the pension plans and how do we really differentiate between the two broad versions of pension plans, which are the defined benefit pension plan and a defined contribution pension plan. So slightly a lengthier session, but yes, it gives you a very good picture regarding what is the role of insurance and pension plans as a part of the risk management process. Now, a quick introduction tells us that insurance companies per se, if you talk about their major role, they are trying to provide protection against the adverse events. Any kind of adverse event occurs, so it could be with respect to life, the adverse event could be a death, or it could be a illness of a person, serious illness, or with respect to an automobile, it could be a kind of an accident, it could be a big damage to a property. Now, these are all adverse events. Now, insurance as such is a vehicle which will protect us against all these adverse events. And terminology wise, the individual or the company who wants that protection, who is looking for that protection, we call them as policy holders. Policy holders will have to make regular premium payments, periodic premium payments to the insurance company, and when one of these adverse events occur, the adverse events need to be specified as a part of the insurance policy. The insurance policy is an agreement between the policy holder and the insurance company. So, at regular intervals, the policy holder will keep paying the premiums to the insurance company, and when an adverse event that is specified as a part of the policy contract occurs, then the insurance company will compensate the policy holder based on the various events that are occurring. Now, if we are looking at different categories of insurance companies, broadly we can put them under life insurance and non-life insurance, otherwise called as property casualty insurance. We have health insurance, which generally has some kind of overlap into life and non-life, but again nowadays it has come out as a completely different category of insurance altogether. So basically trying to understand the health insurance is also very important. And then the pension plan, which also is a kind of one of the major businesses as a part of the insurance companies. Looking at some of the key characteristics of each of them, the life insurance company, life insurance policies are generally for longer terms, 15 years, 20 years, 30-year kind of policies. And in these life insurance policies, we talk about the payments or the benefits that are being provided to the beneficiaries of the policy holders, because when the policy holder dies, the major event that happens in a life insurance company is the death of the policy holder. So when the policy holder dies, the benefits associated with the policy will be passed on to the beneficiary of the policy holder. So those kind of policies come under the life insurance policies. We have different variants of life insurance policies, which I am going to quickly run through from my next slide onwards. So business wise, life insurance business is generally a long term business where the payments are being done to the beneficiaries of the policy holder, especially at the time when the policy holder dies. Coming to non-life insurance, otherwise called as property casualty insurance, it's generally for a short-term period, generally for 1 year, and you have to keep renewing it year after year. And the major things that get covered as a part of this are any kind of losses that are coming because of accidents. It could be because of the vehicle getting into an accident, or an individual getting into an accident. So all these things, anything that is getting into an accident, fire, theft, all these things, the compensation against the losses that are coming up of all these kind of damages come under the non-life insurance business. And coming to the health, we are very clear. So the benefits are more regarding the health of the person. So it could be so this just like any other policy, regular premium payment is being done by the policy holder, and when some of those unexpected events occur, the payouts are typically being made to the policy holder by the insurance company. So the events could be like, I want to get examined by a doctor. I can get the proceeds from the insurance company. Or I want to, a patient, the policy holder wants to get admitted into a hospital and get treated for a particular disease. Even in that case, the benefit can be provided by the insurance company. Or probably some kind of prescribed medication is typically required. Even in that case, the insurance company can typically pay to the policy holder. And because nowadays the cost of providing healthcare is going increasing leaps and bounds year over year. There is a very heavy exponential growth in the costs of providing healthcare, which means even if the insurance company has to compensate those costs, it has to charge higher premiums from the policy holders. So we could see that the insurance premiums are also going higher and higher year over year in the health insurance segment. So that's another major category of insurance company. Then we have pension plans. This is also a kind of insurance which is generally offered by the companies for all their employees. So this is more and more associated with a retirement plan. So some kind of an income is required for the employee when he or she retires, so that during the retirement phase they lead a very comfortable life, and that is what we are calling as a pension plan. Right? Pension plan is more like some kind of a provision for the during the retirement of the employee. So whenever during the working period, when the employee is still working, both the employee as well as employer, they contribute some amount. So they make regular monthly contributions to the plan, and whatever the amount that is accumulated, that would be invested in different kinds of investments, so that whatever the money that comes out in the future after the investment, that would be given to the employee during his or her retirement process. So that is what goes as a part of the pension plan. So we could see that in the insurance case, these four broad categories of insurance companies could be there, and some of the key characteristics that are associated with each of these four companies. But getting a slightly quickly into the details of the life insurance. So the payment is happening to the policy holder here when the policy holder dies. There are different kinds of policies. The most common one is a term life insurance, or otherwise called as a temporary life. So there is a specified term here, let's say 5 years or 10 years, some kind of a period. So if the policyholder dies during that particular period, during the 5 years, if it is a 5-year term life policy, then the insurance company will make the payment of whatever is the benefit to the beneficiary. But in case the policyholder does not die during that period, no payment is done. But to get that benefit to be paid, regularly premiums need to be made paid by the policyholder to the insurance company until that total term of the policy. Every year he or she has to make the premium payment until the total term of the policy, or in case the policyholder has died during that term, during that period, after that the premiums need not be paid. But if the policyholder is still alive, until the end of the policy at regular intervals, let's say annually, the premiums need to be made to the insurance company. And in case there is a death, the face amount of the policy would be paid. And most of the times we see that that face amount or sum assured, sometimes we call it as face amount, or sometimes it is otherwise called as sum assured. So the total sum that is assured, it could be constant or it can decrease with the passage of time. So if it decreases, we call it as decreasing term life insurance policy. So basically when the policy has started, the sum assured may be 100,000. But after 1 year, the sum assured may become 90,000. After 2 years, it may become 75,000, and so on. And there could be a different variants within the term life, and one common variant is an annually renewable term life policy, where the insurance company is giving a kind of a guarantee to renew the policy to the next period without having any kind of medical checkups or some kind of additional checks on the health or the health of the policyholder. So that is what is could be an additional benefit if I am going with an annually renewable kind of a term policy. So we have other sets of policies: whole life insurance policy, otherwise called as a permanent insurance policy. It provides protection to the life of the policyholder, and because the policyholder can die at any point, there is no time period here. So which means that some point or the other there is a death that is going to happen. So until the death, the policyholder has to make the premium payments, and when the death of the policyholder occurs, the face value of the policy is being paid as a benefit to the beneficiaries of the policyholder. So because the payout is more certain, in the term life, if the person does not die during that term, no benefit is paid. Whereas in case of whole life, it is very much certain that the person is going to die at some point or the other. So because there is a certainty for a payout, the premium that is charged in case of whole life is higher compared to that of the term life. And here there are some additional benefits also that are there. Whenever the policyholder wants to surrender his policy, redeem his policy, he can very well do that. Right? He says after 5 years or 10 years, no, I can't pay the premiums anymore, so I want to surrender my policy. So he can very well do that. There will be some amount of penalty that would be applied, and after the deduction of the penalty, the remaining amount will be paid back to the policyholder, and the policy will nowhere be in existence from then onwards. In some cases, the whole life insurance can also be used as a collateral for the loans, because what happens is, let's say it's a 20-year policy, right? And the premiums are collected every year. Generally, we will have a level premium. So every year the premium that is collected is equal. Now you think of a person who is 20 years, the chance of he dying here in the first year is very, very less, whereas the chance of he dying after 18, 19, 20 years is slightly higher. Now because of this, the risk is much higher in the later periods, whereas we are talking about much lesser risk in the earlier periods. So logically speaking, the premium has to be much lower in the earlier period and it has to be higher in the later period. But in the later periods, probably he may not be in a position to earn at all, whereas here he will be in a very much in a good position to earn and pay. So because of all these restrictions, the insurance companies typically charge a premium which is more or less uniform across all the years. So in the initial years, there is some level of a reserve that is getting built, some level of surplus. There is some level of surplus that is getting built because the risk is much lower. So the actual amount that has to go towards the policy should be much lower. But the policyholder is paying a much higher premium here. So that excess is what we are calling as the surplus, and the surplus that is generated in the initial years is generally used to fund the deficit that is going to come up in the later years. And along with that, in a whole life policy, we are also talking about a savings element. The saving element is whatever is that part of the premium that is not needed. Let's say here the premium that is needed is $500, but the insurance company might have charged $2,000 as the premium, right? To just cover the loss of risk here, $500 is sufficient, but it has collected $2,000. So which means the $1,500 is a kind of a surplus, and that I will call it as a savings element. So that amount of premium is typically not necessary to cover the risk for the payout. So this will go as a part of the savings plan. And these kind of savings, they do provide some kind of tax advantage because the payout, it is deferred. The tax is deferred as long as this investment plan is going on. And whatever the benefit that is being given to the beneficiary, that is entirely tax free in some cases. So because of that reason, people want to get into the whole life insurance purchases because there is a tax benefit as well as a kind of death benefit that is covered as a part of this policy. Then the other variant of the insurance which is offered by life insurance companies is variable life insurance. In some countries like India, it is called as ULIP, Unit Linked Insurance Policy. So instead of now here the main element is the savings element. So the savings element, we have said that whichever is the portion that is not necessary to pay the payouts of the benefits to the beneficiaries, that part is called as a savings element. The insurance company will be investing those savings and provide additional benefits to the policyholder. Whereas here, that savings element, where to invest, how to invest, that portion of it, instead of the insurance companies taking a decision on the investment of that extra surplus amount, that option is given to the policyholder himself. The policyholder can choose into which kind of a fund that surplus amount can be invested. So he can think of investing in an equity fund, or he can choose a bond fund or a money market fund or a combination of these funds based on his or her risk appetite. So that is the typical difference between a variable life insurance and a whole life insurance. In a whole life insurance, the investment part of that surplus is taken care by the insurance company itself, whereas in a variable life insurance, that investment decision is taken by the policy holder only. And in case the death happens, there is a minimum guaranteed payout which the insurance company will guarantee. But in case the funds are performing much better, there is a possibility that the amount that is received could be much higher as well. And in some cases, if more income is received, it can be even used for adjustment of the premiums also. And once I have decided as a policy holder that I want to invest in an equity fund today, I still have the option of switching between the funds. So today I might have decided that I will invest in an equity fund, but at a later point I can change my mind and I can get into investing into a bond fund or a balanced fund, which is a combination of both equity as well as bond investments also. So that's the kind of flexibility that is being offered by variable life insurance policies or ULIP policies. So in that case, the risk is entirely with respect to the policy holder. It does not lie with the insurance company. In a whole life insurance, the entire risk relating to the investments and the returns on the investments are borne by the insurance company, whereas in case of variable life insurance, that entire risk relating to the returns on investment and all are borne by the individual policy holder himself. Then comes the next set of policies that are offered by the insurance companies: whole life, which is again a part of the universal life, which is again a kind of whole life insurance itself. The only difference being the premium wise. Initially we said it's a level premium. The premium has to be paid every year, and only then the death benefits will be paid to the beneficiaries in case the unexpected event happens. But in universal, there is one extra option. If required, the policyholder can reduce the premium. They can set some kind of a minimum level, and as long as the policyholder is paying that minimum level of premium, the policy will not lapse. It can still keep continuing. Everything else remains the same, right? The only difference being the policyholder has some kind of additional option where he or she can pay a reduced premium but still continue with the policy itself. So there is a minimum guaranteed return. So here the investment is not done by the investment in the fund is not done at the discretion of the policyholder, but the insurance company only will take the decision of investment into which kind of fund this amount needs to be invested. But they give a guaranteed minimum return in case the death is going to occur. Again, there are two options which can be chosen by the insurers, by the policyholders. The option one says it's only a fixed death benefit that is going to be paid, whereas in option 2, along with the fixed death benefit, depending on the investment returns above the guaranteed minimum, the the policyholder can choose a higher amount as well. So there are two options that are there as a part of this universal life policy. Now, a variable universal life insurance is nothing but it's a combination of variable, means the investment decisions are in the hands of the policyholder, and universal because the premiums can very well be reduced to a minimum extent. So that is the operation of a variable universal life insurance. You can quickly go through them. We just need a basic understanding of the various products. Then we are talking about endowment life. Endowment is basically until the person is alive. So if you talk about pure endowment, right, we are talking about the payout being made only if the policyholder survives for a particular term. Right, we are talking about a 10-year pure endowment policy. Then the payout will be done to this policyholder if he is surviving for all the 10 years. If he is dying, let's say after 8 years, no payment will be made to the beneficiaries of the policyholder. That is a pure endowment. But in most of the cases, we don't have pure endowment policies. We have endowment life insurance based policies, wherein, yes, one, we have a specified period. Let's say it could be for a 10-year period. But the payments are not just for survival. Even when there is a death also, the payment exists. So it's a kind of a mixture of both life insurance, right? These are a mixture of life insurance plus endowment. Because endowment per se in its pure form will get the payment only if the policyholder survives the entire life of the policy. But the typical endowment life insurance policies, they pay a lump sum when the policyholder dies, and another lump sum when the policyholder survives to the end of the period. So whichever happens first, that payment would be done. So again, what amount, how much will be the death benefit and how much will be the survival benefit, they all need to be specified in advance. And in some cases, there is the flexibility that even if the policyholder has stuck with some kind of a critical illness, to treat that illness also the payment can very well be released. Now within this endowment life, we have different kinds of sub sectioned policies. One, we are talking about with profit endowment life insurance. So at regular periods, there are periodic bonuses that are being declared by the insurance company, and that bonus is also added to the overall payment that is being done to the policyholder. So that bonuses, again, there are different ways of computing that bonus, but and when the policyholder is survived for the entire period, at the end of the period, along with the amount that is committed, even the bonuses also can be paid additionally. That is what goes as a part of the with profit endowment life insurance policy. Then we have unit linked endowment policy, where the amount that is paid on the survival of the person, instead of a fixed amount, we are looking at what is the return that is coming on the fund that the policyholder has chosen. So based on the return that the fund has generated, the payment to the policyholder is typically done. So that is what is the unit linked endowment. And pure endowment, I have already discussed. The payment occurs only if the policyholder survives up to the end of the life of the policy. So this is one more product that is offered by insurance firms. Then group life insurance also is typically offered, where many people are covered under one single policy. Generally, companies purchase it for their employees. So they could be either contributory or non-contributory. In contributory, the premium is paid both by the employee as well as the employer, whereas in non-contributory, it's only the employer who is taking care of the entire premium payment. And if you look at it from the operations of the insurance company, they are covering many employees in one single policy. So they have a lot of economies of scale. More number of people covered under one single policy, the administrative costs are much lesser, the selling marketing costs are much lesser, and in some cases they may even omit the medical tests in the whole process, because they will take it like, okay, some of them will be much better off, some people will have very high, above average kind of risks, and some of them are below average kind of risk, some of them are very highly preferred kind of risk, some of them are very substandard kind of risk. Overall it will average out. So that's the kind of mechanism that is typically followed in the group life insurance. Then the annuities are more like pension plans, where the lump sum amount, so if you see in life insurance, the individual is contributing regular premiums, and this entire thing is pooled and invested, and finally when the death of the person has occurred, it could be a kind of a lump sum that could be paid as a beneficiary into the account of the beneficiary. So when the person dies, this benefit is typically made. But in case of annuity, it's other way. So there are amounts that are being pooled, right? This pooled amount will be invested, but this would be given in some kind of installments, so that the retirement can be funded, retirement benefits can be taken through this annuity. So the policyholder makes a lump sum payment to the insurance company, and the insurance company agrees to provide it as a kind of different installments over the entire life of the policyholder. So as long as the policyholder is alive, these benefits are typically received by the policyholder until he is alive. So it could be an immediate annuity, which means the payments can start right from the next month itself, or it could be a deferred annuity where the benefits will be received, let's say, at the beginning after the retirement period starts. So all these are different kinds of different kinds of policies that could come under the category of life insurance. Similarly, in the property and casualty insurance, we have two major headings: property insurance, where we are talking about a protection against the loss or damage to a property. So property, it could be a car, or property could be a building or whatever. So it could be damaged because of fire, theft, etc. And there is a protection against all these things in case of property insurance. Casualty insurance is more related to the legal liability exposures. I have hit someone with my car, so there is a legal liability against that particular person. So a casualty insurance is trying to protect me against the legal liabilities to someone else. And in some kind of insurances, these two can be clubbed, just like my car insurance. If my car gets damaged, it's a kind of a property insurance. And if because of my car someone else get injured and I'm legally liable to compensate his medical expenses, then the casualty insurance is coming into picture. Generally, the property and casualty insurance is for a 1 year period. I can renew it from year to year, and the insurance company will assess the condition of the property, and based on that the premiums are typically decided. So in case of PNC companies, they generally get involved in many different types of insurance. They get into vehicle related insurance, they get into home related insurance, they could get into home contents related insurance, they get into marine insurance. So there are different kinds of insurances that they typically get into. They get into personal accident based insurance. So they get into different kinds of insurances, because of which there is a natural diversification in a property casualty insurance, whereas that may not be that straightforwardly evident in case of life insurance, because the major thing that is there as a part of the life insurance is the death of the individual itself. And within this property and casualty, there are some kinds of catastrophic risks also that are possible, especially because of natural disasters. There could be property damage that can occur, there could be casualties that can occur. So these are all coming under the catastrophic risks. So how many people will be involved, how many properties will be damaged, how much of liabilities will come out, all these things are very difficult to predict in case of catastrophic risks. And here all the losses are not independent, because in case there is a earthquake that is occurred, all the people within that particular region, all their properties will get badly damaged. So the property insurance need to be provided to all these people. It's not independent, each one is not independent of the other. If it occurs, it will occur for everyone. The payout has to be done for everyone. If the earthquake does not occur, no one will need to be paid any kind of a benefit. So it's a kind of all or nothing kind. So the way that the insurance companies have to evaluate these risks is completely different from they evaluate the typical regular routine property and casualty risks. Liability insurance again is slightly difficult to predict, because how much of damages can occur to the third parties this year, and in some cases the liabilities can occur because of something that has occurred few years back altogether. The claim could be made several years after the insured period is over. So that's the reason we call liability insurance as a long tail risk. So the claims had to be made. I cannot close, just that this year the policy is over, so I cannot close the claims under this policy. Under the liability insurance, it is very much possible that the claims may have to be settled even after a few years after the policy has been in force. So this is where the whole complication comes in terms of evaluating the liability insurance, which would otherwise be called as long tail risk. The risk has the risk calculation has to consider multi years, not just the year of the existence of the policy itself, because the claims can be initiated few years after the policy has been in force altogether. Right? So that's how we can talk about the different kinds of insurance companies and the kind of typical businesses that they are into. Talking about the different risks that are faced by the insurance companies, one of the major risks that we need to understand is the policy reserves are not sufficient to meet the claims of the policy holders. When I say policy reserves, see, we have talked about initially that there is a surplus that is coming up, right? Because more premium is collected in the initial years than that is required for the payout. So that additional amount, that is the surplus, that surplus is invested to earn some more interest income. So that entire thing is the typical reserve that the policy is having. So primarily based on the premiums that are collected till date, how much of it is in excess to the risk related payout, and whatever is that excess, we are looking at the interest income that comes on the top of it, and that is what we are calling as a policy reserve. So that reserve would not be sufficient to meet the claims. Means in some cases the claims are much higher than the premiums that you have collected. So it's basically like the premium that you have collected is much lesser than what the claim amounts you are paying out. So your expectation regarding the number of deaths is much lesser than what the actual number of deaths have occurred, and because of which you are paying more claim amount. So that is one of the major risks that is associated to the insurance companies. Your assessment of the loss, and based on which you have determined the premium, is resulting in such a way that the loss is more than the anticipated, and because of which the premiums that you have collected are nowhere sufficient enough to meet the claims. So that's the biggest risk that is faced by the insurance companies. Even regarding the performance of their investments, as I said, the surpluses are invested. So the insurance companies expect that they receive some amount of return on their investment. But it might so turn up that they receive much lesser than what they are anticipating. So whatever is the premium amount that they have received, taking out the risk amount associated with it, the remaining part, which is the reserve, that reserve is typically invested by the investment insurance company. Generally they invest heavily in corporate bonds. Now this corporate bonds, there is a possibility that they may default. They have a risk of default, and because of that, whatever the investment that the insurance company has done in these corporate bonds, it may not be recovering the full amount, which means the overall profitability of the insurance company is getting affected. So they need to diversify, even if they are going for corporate bond investment, they need to diversify across different types of bonds in terms of maturity, in terms of the risk, in terms of the ratings associated with each of these bonds. So that's another major risk that comes with for the insurance companies. Even the liquidity risks they need to monitor very carefully. Sometimes they invest in high yield bonds. So those bonds which do not have a good credit rating, typically double B and lower credit ratings up to let's say triple C, they are all categorized as high yield bonds. So they generally invest sometimes some portion of the money they invest in these high yield bonds. Though they are risky, they invest them with an anticipation of higher returns on them. But at the same time, they are very highly risky, and in some cases, they would not be in a position to get converted into cash immediately. When a claim has to be paid, I cannot sell those bonds, high yield bonds, immediately and use that proceeds to make the payment. So that's where the illiquidity is the kind of scenario where I may not be in a position to sell off the bonds immediately and use the proceeds for the payment purpose. So even that kind of a risk exists with the insurance companies in their insurance business. Obviously, credit risk is something that is inbuilt for the insurance companies because they enter into different kinds of transactions with banks, reinsurance companies. So there is a quite a good amount of chance that one of the parties or few of the parties with whom they have entered into these kind of contracts, they may default, they may dishonor the contract. So to that extent, credit risk is present for the insurance companies. Just like banks, they are also exposed to different kinds of operational risks like fraud, system failures, network problems, lot of things where they might end up into a losses because of not properly planning and estimating the operational activities. So just like in case of a bank, against all these risks, which are very much possible for an insurance company, the regulators, they come out with the amount of capital requirement. Just like the banks have to maintain some amount of a capital as a cushion against all the risks that they are facing, even an insurance company is bound to maintain minimum amount of capital as a cushion against the losses that it can very well anticipate. So different kinds of risks faced by the insurance companies and the capital requirements again as a cushion against all these different kinds of risks. Then the other important aspect, primarily with respect to the life insurance here, is the concept of the mortality table. If I have to determine the premium associated with the life insurance contract, probably the major source of information is the mortality table. It is prepared separately for males and females for all age groups. So the way the table will be is, probably if I am looking at for males, there are 4 columns in general. The first column will be the age of the person. So it will go right from 0, 1, 2, 3, so on up to 100 or more. Now, the second column is the probability of death within 1 year, right? Typically called as Q of X. So the probability of death. So now here there will be some percentage which says what is the probability that a person aged 0 right now will die within the next 1 year, right? What is the probability that a person aged 1 just now will die before he gets 2? So within the next 1 year. Probability that the person aged 2 will die before he reaches the age 3. That is the probability of death within 1 year. So the probability of person who has just reached the age X, what is the probability that he will die within the next 1 year? So that is the second column that is there. Then we are talking about survival probability. Survival probability says what is the probability that a person survives up to this age. Right, if I am talking of 50 here, what is the probability that a person who was born 50 years back, he has survived up to this age of 50? Right, what is the probability? So this says what is the probability that a person aged currently 50 dying within the next 1 year? Whereas this one says, first of all, right from the birth, what is the chance that a person will survive for 50 years? What is the chance that he did not die in the last 50 years? That is what will be shown as in the third column, survival probability, sometimes shown as P of X. And finally, the fourth one, which is the life expectancy, it talks about, okay, for this person who is currently age 50, how many more years he is going to live on an average. So the remaining life expectancy on an average, what is the number of years, what is the, how many more years this person is going to live. So these are the four things that would be present as a part of the mortality table for each age, and for different groups this is typically prepared. So what you could see is the probability of death, this Q of X, during the next year is a decreasing function of age for the first few years. So in the initial years, so probably at 0, the probability of death is much higher. 0, 1, 2, but probably by the time he comes to 8 or 10 years, the chances of death keep going down. But again, after let's say 10, 15 years, up to the 100 years, the probability of death keeps increasing and increasing. That's a typical trend that we see. Even the common trend is the mortality statistics for women are little more favorable. So the probability of deaths for women are slightly lesser compared to the probability of deaths for men for the same age groups. And a few calculations, probability of a person aged X. If I have to look at what is the probability that he is dying in the second year, it means that I need to find out the probability that he did not die in the first year, but he has died in the second year. So if Q50 is the probability that he will die in the first year, right? And Q51 is associated with the probability that he will die between 51 and 52. Then we are talking about a person aged 50, he dying in the second year, is, I am talking about the probability that he will not die in the first year, 1 minus Q50, multiplied by Q51, the probability that he will die in the next year. So this would be the combined probability that a person who is alive now will die in the second year from now, not in the first year. So we have to do those kind of calculations. I'll take one example which will simplify your overall understanding. And the life expectancy is, I'll take the weighted average of the years of survival and the probabilities for that entire period, assuming that the death occurs on the average halfway. So if I am talking about a death, it does not occur at the beginning of the period or at the end of the period. I am assuming that somewhere in the middle the death is going to happen. So based on that, the life expectancy is computed. So depending on what is the probability that he will die in the next year, what is the probability that he will die 1 year after that, what is the probability that he will die 2 years after that, all those probabilities multiplied by the number of years that he is going to live is being considered to calculate the life expectancy of the person. So let's look at one numerical. that will take us through many important aspects per se. Let's look at this table. Right, this is the table I want to look at. So this is the age, these are the ages of the person. This is the probability that he will die within the next year, within the 1 year. So this is the probability that he has survived up to this particular age. So I'll say that a person among all the people, a person surviving up to age 90 has a probability of 16.969%. Now, given that this person has survived, the chance that he will die within the next 1 year is 16.835%. So the chance that he will survive for one more year is 1 minus this into 0.169. So if you really want to look at this calculation, let me just bring out the spreadsheet to show you how this calculation is coming out. Let's see here, for a person aged 90, we are saying that the probability that he will die in the next 1 year is 0.168352. Right, and the probability that he has survived up to 90 years itself is 0.16969. And from here his expected lifetime is 4.02 years. Let's keep this part aside. Now, if I have to compute this one, the probability that he will survive up to 91. So, the probability that he has survived up to 90 is 0.169. And the probability that he will die in the next year is 0.168. So, the probability that he will not die in the next 1 year is nothing but 1 minus of this. So there is a 83% chance that he will not die in the next 1 year. So the probability that he will still be alive at the end of 91 also is nothing but the probability that he is alive up to 90 multiplied by the probability that he is alive between 90 and 91. He did not die in 90, between 90 and 91. So this has worked out to 0.14112, and this is what is the number that you have got, 0.14112. So that's how this table gets updated. Right, initially we will look at what is the Q of X is an important part. So we are trying to assess what is the probability that the person will die in each of the periods. Based on that, the P of X table is computed, and based on taking the weighted averages for the remaining periods, the expected life expectancy of the person is computed. But here, my objective is not preparing this table. Let's say this table is given to me. Right now, let's say this table is given to me. Assume that the interest rates for all the maturities are 4% per annum. So the interest rate R is 4% per annum and semi-annual compounding. So for each period, I would be considering as 2%. I'll consider each period as 2% because it's a semi-annual compounding. I'll take it as RM. So I'll take it R2, which will make it as 2%. Premiums are paid once at the beginning of the year. So for the first period, there is a premium that is being paid, and in the second period beginning the premium is paid, the third period beginning the premium is being paid. So once at the beginning of the year. What is the insurance company's break-even premium per 100,000? So the face value is 100,000. 2-year term life insurance. So we are talking about a 2-year insurance policy, which means the premium would have been paid, some premium would have been paid here, some premium would have been paid here at the end, at the beginning of the second year. For a man of average health aged 90, so we are considering a person here Assume that the payout occurs halfway throughout the year, which means the death can happen. If at all the death happens, either it can happen here or it can happen here. So there is a possibility that the death will occur here or the death will occur here. Right? We have to consider these two scenarios of the death occurring. Assuming the payments are premiums are paid at the beginning of each of the years. So I am doing one premium payment here, I am doing another premium payment here, and the premium is not paid for the second year if the death happened in the first year. That's the typical rule. Now based on that, I have to compute what is the premium that this company should charge if it is going for 100,000 as a break-even premium. Okay. So this 100,000 might be paid either here or here, because I am assuming that the death will happen somewhere halfway during the period. So the death can happen either here or here. Now I know if the death has to happen here, if the death happens here, I have to pay 100,000. I will find out the expected claim if the death happens in the first year. Right, this is how I will proceed. Expected claim if death occurs in year 1. That's one thing that I have to compute. And the other thing I have to look at is expected claim if the death occurs in year 2. Year 2 means after 1.5 years. Year 1 means after half year. So let's assume these two scenarios. Alright. Now what is the probability that the person will die in the first year? This is the probability. So the probability of death in first year. How much is it? 0.168352. So this is the probability of death in the first year. So in case the person dies in the first year, the payment has to be made 100,000. So we can say expected claim in year 1 if the death happens in year 1. So it is nothing but this amount multiplied by 100,000. So the expected claim in year 1 is 16,835, and this is the amount that has to be paid out here. So if I want to find out the present value of this claim amount as of here, I will discount this. So PV of the expected claim. So this I will take it as, this is the expected claim divided by 1.02, because it's a 4% per annum and semi-annual compounding. So I'll take it as 1.02. So resulting in, this is the present value of the expected claim in case the death happens in the first year. Now the probability of death in year 2. So it means that the person has to be alive in year 1, and provided he is alive in the year 1, he is dying in the year 2. So what is the probability that he is of death in year 2? I am first taking the probability that he will not die in year 1. So this is the probability that he will not die in the year 1, and the probability that he will die in the year 2. This is the probability, because in the year 2 means he has reached 91 and he is dying at 91. So the probability that he will die in year 2 is 0.185486. So this number 0.185486. So this is the probability that uh, 0.18. So this is the probability that he will die in year 2. So in case he dies in year 2, the expected claim in year 2 is how much? This number multiplied by 100,000. So this is the claim amount, assuming that the person will die in year 2. Then I am finding out the present value of the expected claim amount. So for each year we are doing this. Now because in the second year if he is dying, it means this is the point, midway. So I can very well discount it over the 3 semi-annual period. So I'll discount it as 1 by 1.02 cube. So this is where I'll take it as this amount divided by 1.02 cube. So this is the present value of the expected claim, assuming that he is dying in the second year. So that way, now this is the expected claim if he is dying in the first year. If he have survived the first year and he has died in the second year, this is the expected claim. So total expected claim amount, assume whether it is for the first year death or second year death. So which is working out to this much plus this much, resulting in 31,000. So 31,000 is the expected claim amount out of this particular policy, because it might be very well possible that the person may die in the year 1 or he may die in the year 2. Assuming that he is dying in the year 1, the expected claim amount is this much, because the death probability of death is this much, and in case there is a death, the payment of 100,000 needs to be done. So similarly, in case he is alive in the first year and he is dying in the second year, this is what is the claim amount, expected claim amount, and the present value of the expected claim. So overall expected claim amount is this much. Okay. So let me take the expected claim amount is 31,041. So on an average, if at all a person dies, this is the amount that may have to be paid. Now based on that, I'll try to look at the premium. So initially he is paying a premium X, right? And another X is also being paid at the beginning of the second year. But this premium is paid only if the person has survived in the first year. So I need to take the probability of survival for the first year, and then only those many people will pay the premium in the second year, right? So I am computing the premium that is paid in the first year. I'll take it as X, and because it is paid right away, there is no discounting also. But whatever the premium X that I am paying here, the present value of it will be 1x by 1.02 whole squared, because this is paid at the beginning of the second year. Alright? And not everyone will pay the premium, only those people who have survived in the first year. So probability of survival in year 1, which is nothing but 1 minus of the probability of death in the year 1. So there is 0.831648. So it is coming out like this into 0.831648. This is the total present values of the premiums that we are receiving. So this total amount, which is the present value of the cash flows, should be equal to the expected claim amount, which is the present value of cash outflows. So based on that, I can very well compute this. This divided by, so I want to find out the present value of this amount. So the present value of this amount is coming out to this divided by 1.02 whole squared. So 0.7799. So based on that, we are saying X plus 0.799X should be equal to this much. And based on this, I can say my X, which is the premium amount, is nothing but the total expected claim divided by 1 plus 0.799, resulting in a premium amount of 17,251. So that should be the minimum premium that I have to charge every year to ensure that the claim amount will be met with this premium. But there is a chance that more deaths can happen than this percentage. More number of people may die. In that case, the premium that is collected may not be sufficient to make the claim payment. The interest rates could be different. In that case, my whatever I have invested will not fetch me that 4% return. It could fetch lesser than 4% return. So those are all the risks that we are typically taking. But this is how we get into the process of calculating the premium based on the mortality table. So for each, you have to see where all the deaths are occurring. So if a death is occurring across each of these periods, then how much should be the expected claim amount? Find out the present value of that expected claim amount for all the possible deaths that can occur. So based on that, you are getting your overall expected claim amount that you have to pay, which is like your expected cash outflow. And you are also looking at expected cash inflow by looking at the premiums that are getting collected. Initially, everyone has to pay the premium, but the second premium will come only to those people who have survived at the end of the first period. So in case the death did not occur in the first year, I have to compute the probability of that, and that would be only those people would pay the premium for the second year. So based on all these calculations, it worked out that the premium that I have to pay is coming out to some 17,251. So I hope this calculation part is quite clear. You have to be comfortable with the calculations from the mortality table this way. Then, moving on to a property and casualty company, there are different ratios. These are computed even for life insurance as well. Different kinds of ratios that we are typically computing to ensure how good is the performance of the insurance business. First thing, we look at the loss ratio. Generally, what is the amount of payouts that we are doing, which is like the claim settlements. What is the amount of claim settlements that we are doing divided by the total premiums that we have collected. So basically the outflow with respect to the claim settlements divided by the inflow with respect to the premiums collected. That is what we are calling as the loss ratio. Generally it will be in the range of 60 to 80%, right? That's a major expense associated with the insurance business. Then comes the expense ratio, where the expenses of that particular year divided by the premiums that are earned in that particular year. So when you're talking of expenses, there are two major expenses here. One is the loss adjustment expense, which is talking about I really need to assess how good is the loss. So people have filed a claim. I have to really assess the goodness of the claim. Is the claim really valid? Is it a bogus claim? Right? And how much should the policy holder be paid? So that is where we are getting into the expense ratio. Right? One of the major component of the expense ratio is loss adjustment expense, wherein we are talking about the validity of the claim and how much the policy holder should be paid. The selling expense is the other major component of the expense ratio, which is more associated with the commission that is getting paid to the brokers. So generally for acquisition of the new business, it comes under the acquisition of the new business. So 25 to 30% is the typical range. And these two ratios put together will become the combined ratio. And in some cases, if the dividends are also being declared, then it is the loss ratio plus expense ratio plus dividend ratio That is becoming the combined ratio. And if this combined ratio is greater than 100%, it means that compared to the premiums that are collected, the claims and the expenses are much higher. So this is where the company is going into a loss. But remember one thing, this is where the time value of the money needs to be taken into consideration, because the premiums are generally collected at the beginning of the period, whereas the claims or even the expenses, they are spread out throughout the year. So even in the worst case, they are associated with somewhere in the middle, if not towards the end of the period. On an average, I have to take them as during the middle. So because of that, I have to make that kind of an adjustment, because during this period my premiums would have got invested and I would have got investment income out of it. So when I am adjusting the combined ratio with the investment income, means that I am reducing the investment income from this expenses because I have earned a return. That is what we are calling as an operating ratio. And if this operating ratio is still more than 100%, then I can really take the loss as the situation. I have made a loss on the business and I should really reduce some of these expenses. But in case the combine after removing the investment income, if it is coming positive, which means if the operating ratio is coming out to be positive, then it's not a loss on the business that is executed. So some of the ratios that are typically computed by everyone, but especially the property and casualty companies, the numbers that I have specified in the ranges, they are more and more applicable to a PNC firm. Then, the next topic that I am talking about in this session is the moral hazard and adverse selection. Some of the two common risks that are very heavily prevalent in insurance companies. Moral hazard is a kind of a risk that, because there is insurance, we have discussed about it even in the banking discussion. Just because I have an insurance, the policy holder is behaving differently compared to if he has not taken the insurance. I have given an example earlier also. I am a car owner. I have bought an insurance policy regarding the car being stolen. Against the risk that my car can get stolen, I have taken insurance, which means I am keeping on paying the premiums, and in case the car gets stolen, I would be compensated by the insurance company. But just because I have taken the insurance, I would not lock the car. I am least bothered about locking the car. Just think about it. That is the kind of a negligent activity which is associated with the moral hazard. So I am behaving completely differently because I have insurance. If I did not have insurance, I would not have taken that step at all. I would have definitely made sure that I have locked my car. It's not a mistake, or it's not by mistake happening. It's an intentional thing. I'm doing something wrong. So the different behavior, because of this different behavior that I am following, the risks are typically getting increased, and because of that the expected payouts for the insurance company are going up quite drastically higher. The same is the case for deposit insurance plan, which we have discussed earlier. Just because there is insurance, neither the depositors nor the banks will typically care for the riskiness of the riskiness of the loans that they are giving. So that is also, they would not have done that had the insurance not been in place. So all these are cases of moral hazards. And in general, how do I deal with the moral hazard in PNC insurance? One, there is a policy limit, which simply says the maximum payout is, there is a limit that is being set explicitly in the policy. there is a maximum limit that is set in terms of how much can be paid. Then there is something called deductible, let's say to the extent of $500 or $1,000, which says whatever is the loss that you are reporting as a claim, for every loss that you have reported, the first $1,000 of that loss will be borne by you, and the remaining will be borne by the insurance company. So that is what is the deductible. Whatever is the amount that is specified as the deductible, any claim that is filed, the initial that many dollars would be paid by the policyholder, and any loss that is beyond that deductible amount will be taken care by the insurance company. And in some cases there could be a co-insurance provision also saying, okay, above this $1,000 which is the deductible, whatever is the loss, let's say the loss is 10,000. So the initial 1,000 will have to be paid by the policyholder itself. So out of the remaining 9,000, if there is no co-insurance provision, the whole of 9,000 will be paid by the insurance company. But if there is a co-insurance provision, so they will say 80%, some percentage will be specified by the insurance company. So 80% of this 9,000, which is $7,200, will be paid by the insurance company, and 20% needs to be borne by the policyholder itself. That is what we are calling as co-insurance provision. So you have to pay along with us. So this is just to make sure that only genuine losses are reported and all the frauds and moral hazards are typically eliminated because of this. So to a large extent, the moral hazard is handled by bringing all these things into picture in P&C insurance. Now, apart from moral hazard, another major risk that is coming for the insurance companies is adverse selection. See, in many cases, it so happens that the insurance company cannot distinguish between good risk and bad risk. Especially who is a good customer or who is a good policy holder, healthy policy holder versus unhealthy policy holder. So very, very difficult to distinguish between these two classes. So because of that reason, both the good risk as well as the bad risk, both of them are offered the same product at the same price. Now because of this reason, it may very well be possible that the person who is a bad risk, he knows that he is a bad risk. So he has more chances of buying the policy compared to a person who is more of a good risk. Because the price wise, that price looks much higher for a person who is a good risk, but that much premium looks much lesser for a person who is with a bad risk. So there is a good chance that that policy will be taken by majority of the people who are bad risk and not by the people who are good risk, because the people with good risk, they feel that the premium that is charged is too high. So if it is not able to distinguish between healthy and unhealthy people, offer the same average insurance premium to both of them. So healthy people find that the premium is too high, so they will not buy the policy. Unhealthy people find that the premium is lower, so they are the ones who are going to buy the policy more. And so the average behavior is getting badly affected, and because of which the insurance company might very well end up into a loss. So adverse selection is purely because of information asymmetry. Right? This could be purely because of information asymmetry. Insurance company is not able to distinguish between good losses, good risks and bad risks, but the policyholder knows whether he is a good risk or a bad risk, and depending on the assessment of himself, so he will find that the policy is either cheaper to him or expensive to him. And because of that, you may find that a lot of people who are bad risk subscribing to a policy compared to a lot of good risk. So it cannot be completely overcome. It will be present in some form or the other. But to deal with adverse selection, So the insurance company should know as much details about the policyholder as possible, which means the information asymmetry should be reduced to whatever extent possible. And regarding the health status, detailed medical examination of the policyholder is required by an approved doctor. And even in case of automobile kind of an insurance, okay, if he is a driver, before instead of giving the same premium for poor driver, for a bad driver versus a good driver, a detailed assessment regarding the riskiness of the driver in terms of number of accidents that he has incurred, or probably how many fines that were against his name. Various things can be very well looked at, and the premiums can be changed from year to year as well. But dealing with moral hazard and adverse selection is very important from the perspective of an insurance company. The major area the insurance companies should still focus on. Right? Now, moving forward, the next topic that we are discussing here is the mortality risk versus the longevity risk. So the words are very clear. Longevity is living longer, than expected, whereas mortality is dying earlier. So dying earlier is one kind of a risk, living longer is another kind of a risk. So these are the terms associated with them. So coming to longevity risk, there are lots and lots of advances that are coming in medical sciences, lifestyle changes coming up. Because of various reasons, there is a chance that people will live longer than the life expectancy. So right now, if the life expectancy is 80 years, on an average now if the people start living for 84 years, now that is what we are calling as longevity, and the risk that is faced by the insurers because of people living longer than expected is what is associated with longevity risk. So it will affect the probability of especially the annuity contracts, especially the pensions, right? Because pension is typically paid, annuity is typically paid until the person dies. Now, on an average, the expectation is the people will die by around 80 years. But now, if as a group, the expectancy has gone up and people are living up to 84 years. So for 4 more extra years, the annuity contracts need to be paid to the policy holders. So there's a lot of payment that is to be done. They have to pay for longer periods, and because of that reason, the profitability of the annuity contracts will get badly affected because of longevity risk. But at the same time, the profitability of insurance contracts will go up, because insurance is typically paid when a person dies. Now the person is dying much later. So whatever the benefit that needs to be paid, that benefit is getting delayed. And if it is a term life policy, there is a possibility that the payment may not be done at all because the person has survived that particular period. So on one side there is an increase in profitability in the insurance contracts, and there is a decrease in the profitability in the annuity contracts, right? So that is how the longevity risk affects the insurance business. But the trend wise, because of various advances in the medical fields, etc., it is clearly observed across the world that the life expectancy has been on a growing path itself. And the opposite of the longevity risk, which is the mortality risk, talking about people dying earlier than expected because of wars, epidemics such as AIDS, or pandemics like Spanish flu. So all these things might result in people dying much earlier than expected. Now, if people die much earlier than expected, the profitability of the insurance companies is getting, insurance business is badly getting affected because more claim payments have to happen very early because the insurance makes the payments on the death of the person. So more payments have to be done more earlier than expected. But at the same time, the profitability of the annuity contracts is increasing because a lot of people are dying early. So the pensions and the retirement benefits need not be paid for longer periods of time. So again, you will find with the mortality risk also, insurance contracts typically losing on the profitability, but the annuity contracts are gaining on it. Whereas in case of longevity risk, it is exactly the opposite. So the mortality and the longevity risks in the annuity business of a life insurance company, they are offsetting those that are of their regular life insurance contract. So that's the reason I could see that the insurance companies typically go with a combination of insurance as well as annuity policies so that one can be offsetting the risks of the other. And actuaries assess the insurance company's net exposure. So to how much are they exposed to the longevity risk and how much are they exposed to mortality risk. They try to assess. So if they are more or less equal, they are offsetting each other. But in some cases, they might be exposed more to longevity risk if they are if they have so many annuity contracts and very few insurance contracts. They are more exposed to longevity risk compared to mortality risk. If they have more of insurance contracts and less of annuity contracts, they are more and more exposed to mortality risk. So the actuary is typically trying to assess under different scenarios what could be the net exposure to these risks. As long as the exposure is in the acceptable limits, fair enough, there is nothing that is done. But if it is going more and more unacceptable, some kind of mitigation of this risk exposure is typically done using various mechanisms, and getting into a reinsurance contract is one such kind of a mechanism to reduce the risk. But on the other side, the secondary markets also can very well be used for reducing this risk, especially by entering into a derivatives contract. Now this is where we have products like longevity derivatives, which will help in terms of hedging the longevity risk. So the payoffs are provided which are attractive to the insurance companies here, especially when they are concerned about the longevity exposure. Right, so there are sellers of longevity derivatives, so which can be purchased by the insurance companies which are selling annuity contracts or even by the pension funds. So these are the typical parties who are entering into the longevity derivatives. So they are giving some kind of attractive benefits to the insurance companies, especially when they are concerned with the longevity exposure. So there is something called longevity bond, one of the most famous longevity derivative. So it's a coupon. The coupon on the bond is a kind of a variable coupon. It's not a fixed coupon. It is almost proportional to the number of individuals in the population who are still alive, more and more associated with the longevity. So more the number of people are alive, more will be the coupon that would be paid, which means it would be a kind of a compensation. And if the number of people who are alive is much lesser, then the coupon also would be much lesser. So that's the kind of instrument that is existing. So which could give some kind of a risk mitigation to the insurance company. But who would be the typical seller of that bond? Look at it from the perspective of a seller who is a speculator. He would be interested in selling these kind of bonds to the insurance companies, annuity contracts, pension funds, because they have a very little systematic risk. So they are nowhere dependent on the market risk, and they don't have too much of a correlation with the market risk. So because of that reason, they may be very much interested. For them, it's a kind of an optimal portfolio in terms of mitigating their risk. So they don't mind selling these kind of contracts which have not much of a correlation with the overall exposure to the market as well. So that's how the longevity risk can very well be hedged, and that's what is the kind of understanding we need to have between the mortality risk and the longevity risk. Then, coming to the capital requirements for insurance companies, we understand that the balance sheet for life insurance and P&C insurance are different because the risk that they take, life insurance is more of long term in nature, whereas the property and casualty is more of short term in nature. So the kind of reserves that they have to plan out for life insurance, the reserve requirement is much higher compared to P&C insurance. So the balance sheet, the structure of the balance sheet is completely different between a life insurance and a P&C. Some of the important things we see with the life insurance, the investments, almost 90% is in investments, and majority of the investments will be in the corporate bonds itself. And because the durations of the liabilities are long term, so we are talking of people dying in 1 year, 2 years, 3 years, 10 years, 20 years. So the maturity of the assets, it tries to match the maturity of the assets with the maturity of the liabilities. So your liabilities could be of differing periods. So what the insurance companies typically try to do is they try to match the maturity of the assets with the maturity of the liabilities. This is what they call as immunization. But they take on the credit risk in case, because they are investing in corporate bonds, in case the bonds default, right? And more and more than the expected. If the default rates are much higher than expected, there is nothing much that the insurance company can do. They are taking on the credit risk. And the major difference between the banks and the insurance companies, you see here, the insurance companies have an exposure both on the liability side as well as on the asset side. Asset side is they have invested in the corporate bonds, and the corporate bonds default. So they have a big risk on the asset side. But on the liability side, yes, there could be a mortality risk, and because of which the reserves that they have set aside may not be sufficient to really make the claim payments. The estimates that are given by the actuaries, though they are very conservative, in some cases they may not be sufficient enough to make the claim payments altogether. So that could be the case in case of life insurance. In case of annuities, it could have been much the reverse. So more people die, which would more than what the actuary might have expected, resulting in more number of claim payments happening in case of life insurance, or very few people are dying. Even that would be a serious problem, which is what is the longevity risk, and that would have an impact on the performance of the insurance companies, especially when they are selling their annuity policies. Now, if you look at it, the reserves are a very significant portion. This is the life insurance company's balance sheet. I could see that the reserves are the very significant portion of the liabilities. Equity capital is 10%, subordinated long-term debt is 20%, and this is how the breakup of the assets and the liabilities exists for a life insurance company. But if you look at a general insurance company, the investments are still more or less the same, 90 and 10. But here the investment need not be corporate bonds of different maturities. Here they would be more or less short term in nature. Whereas you see the reserves are only to the extent of 45, because you are not talking about too much of a long term kind of a perspective. But they have, now if you see, the payouts for a PNC are much less easy to predict. They are very difficult to predict when will a loss going to occur. Compared to a life insurance company, here we have a mortality table, etc. The major thing that is significant regarding the PNC is unearned premium, especially as we discussed earlier. They have the long, especially the liability insurance has something called long tail risk. Right? Here there is a possibility that the claim could be initiated few years after the policy is expired, policy has been in force as well. So the claim associated with 2011 might be filed in 2015 as well. So because of that, probably might have got settled in 2015 as well. So there are a lot of premiums that have been collected, but they have not yet got serviced, and that's the reason you have unearned premium as a part of the liabilities, which is significant to the extent of 15%. And you could see that the equity capital is much higher here to the extent of 30%, whereas in case of life insurance, majorly it is the policy reserves only that is coming on the liabilities and the net worth part. So this is where you will see some kind of differences existing between a life insurance firm and the PNC firm with respect to the capital requirements. Then talking about the regulatory system, in case of banks, the regulatory is more at a federal level, which is the country level regulations are there. Whereas in case of insurance, the regulations are more and more at a state level. Every state has its own set of regulations. And the state is more and more bothered about the solvency of the insurance companies and to what extent the claims of the policyholders are getting met. Though there is a national agency called NAIC, National Association of Insurance Commissioners in US, so it is purely for the discussion among all the state regulators on the common issues and interests. So as far as the insurance companies are concerned, all their annual financial statements are to be filed with the state regulators itself, and any kind of reviews are conducted by the state regulators only, not the federal level. But coming to the capital requirements, the capital requirements are determined based on the standards that are set by NAIC. Each state will compute what would be the capital requirement for this particular insurance company. That capital requirement is typically computed based on the standards that are determined by the NAIC itself. And policyholder is protected against an insurance company just like deposit insurance. The policyholder is also protected against the insurance company becoming insolvent, where there is a scheme of insurance guarantee. So if at all a particular insurance company is going insolvent, here we have small differences. So assume that a particular insurance company is going insolvent. Immediately, all the insurance companies that are there in that particular state, they have to contribute some amount to the state guarantee fund. And this amount that they have to be guaranteed is based on the premium income, that premiums that they have collected in that particular state. So when a particular insurance company X has gone insolvent, all the other companies which are operating in this state, they have to contribute some amount to the state guarantee fund. And this amount is purely based on the size of the business they are writing in that particular state. And this amount will be used by the state guarantee fund, which is the Insurance Guarantee Association, to pay the policyholders of that insolvent company. And in some cases, that insolvent company's policyholders may be taken over by the other insurance companies. So their policies will be transferred to the other insurance companies as well. That's also one more process that could be there. But this is one more difference that you observe between the banking and the insurance. Here in case of insurance, we are seeing that after the insurance firm goes bankrupt or insolvent, then all the other firms which are operating in that state, they are contributing to the fund which would be used to pay for the policyholders of that insolvent insurance company. So looking at the guarantee system, which is a kind of a difference between the banks and the insurance companies, in case of banks, there is a permanent fund. So the premium, so when you look at the FDIC, it collects the premiums from the banks. So it's a kind of a fund that is pooled, and so the banks are paying to the FDIC regularly. And when any of the bank has really gone bankrupt, this fund would be used to protect the interests of the interests of the depositors. Whereas in case of insurance company, there is no permanent fund. The fund is not created on a regular basis. Only after the insurance firm has gone insolvent, then the fund is starting to get created based on the premiums that are being collected in that particular state by the company. So there is no permanent fund, right? It's not being collected on a regular basis, only on a need basis. When a particular insurance firm has gone insolvent, this guarantee system starts operating. And the regulations are not uniform across all the states. Some insurance companies, they trade in derivatives just like the way as the banks, but the regulations are not that stringent, which are very much stringent in case of banks. So some kind of loopholes do exist with respect to the regulatory system associated with the insurance companies. And finally, coming on to the pension plans, and understanding a pension plan, trying to differentiate between a defined benefit plan versus a defined contribution plan. We all know pension plans are typically set up by companies for their employees as a measure for funding their retirement benefits. So contributions are made to the pension plan by the employer as well as the employee, as long as the employee is working. So when both of them are making the contribution, we are calling it as contributory plans. Only one of them contributing, we are calling them as non-contributory. Fair enough. And when the employee has retired, so because of these plans, he or she is going to receive some amount as a pension until their death. So the pension fund, whatever is being pooled, it's a lifetime annuity. The regular contributions from the employee, employer, pooled up, invested, and once the person is retired, after that it gets converted into a lifetime annuity, wherein until the death of the person, periodically some amount is being paid to address the retirement needs of that specific person. So in terms of that payment, there are two major types of pension plans: defined benefit plan and defined contribution plan. The defined benefit plan says that in case of defined benefit plan, how much amount the employee will receive as a pension on retirement is clearly specified. So he will be receiving $50,000 on retirement every month. So that would be or every year. That would be the amount that would be clearly specified by the defined benefit plan. And to compute that, there is a formula. All these pension funds, they calculate a formula how much pension needs to be paid on the retirement of the person. And this pension is computed based on the work experience of the employee, how many years of employment he has already put, how many years does he still carry, and what is the salary of the employee. Based on this, there is a formula that is used to compute how much pension needs to be paid on retirement of this person. And in some cases, even the spouse, provided the employee has died before the spouse, then spouse also will continue to receive the pension. In sometimes it could be a full pension or it could be a reduced pension, especially if the employee dies before the spouse. And in some cases, when the employee dies while still in employment, there is a possibility that a lump sum is payable to the dependents, and after that a pension could be paid to the spouse and the dependent children until their death. And in some cases the pensions may be adjusted for inflation also, which is otherwise called indexation. So all these things are very much possible in doing the computations associated with a defined benefit pension plan. Whereas in a defined contribution plan, yes, employee, employer, both of them are contributing some amount to a particular pension plan. And on the retirement, whatever are the contributions that have been done regularly, they all will be pooled, and that would be converted into a lifetime annuity. So either the employee can keep receiving as a lifetime annuity, which means he can receive on a month-on-month basis some specific amount, or in some cases that could be taken as a lump sum, or in some cases it could be a combination of both a lump sum as well as the remainder being provided as a pension throughout the life of that particular employee. So all these plans can be created, which means in a defined contribution plan, the amount of pension that the person would be receiving is nowhere specified. At regular, on a periodic basis, only some contributions are being done both by the employee as well as by the employer, and the fund is pooled, and whatever the fund amount that gets aggregated, that would be used to purchase a lifetime annuity on the retirement of the person, which would be used for paying the pension throughout the life of the person. So longevity risk is a major concern for the pension plans, which we have already highlighted earlier. When you look at the key differences again between the defined contribution and defined benefit, in defined contribution, the funds are identified with individual employees. So, okay, if it is my pension fund, whatever I have contributed and whatever my employer has contributed on my behalf, so it's a separate fund account. So whatever came up in this particular account, with this annuity is purchased and my own retirement benefits are provided. That's it. So an account is set up, one for each employee, and pension is calculated based on the performance of this fund only. So for each amount there is an account, and whatever is the contribution of the funds in that particular account, based on that the pension for that account is simply calculated. An employee can choose a number of investment alternatives here. So employers don't have the risk here. It's a annuity plan that would be purchased. So the employer has no risk in this process, even if the investment returns are very pathetic. So the returns are not as per the expectations. In all these cases also, it's the employee who is taking the risk here, not the employer. Whereas in case of defined benefit, it's not an individual account. All the contributions are pooled. The benefit that needs to be paid to the employees is decided upfront based on a formula, and the payments are typically done out of the pool itself, no separate individual accounts. So employers have a much bigger risk because they have to take care of the investment process, how much returns are getting generated out of the investment process. If the investment process is generating lesser returns than expected, it's going to hurt their profitability very badly. So there is a significant risk for the employer in a defined benefit plan. And estimating the present value of the liabilities is very difficult. It's an actuarial job that comes into picture, because estimating the discount rate, all these things become very difficult especially with respect to the defined benefit plan. But in both the cases, there is a deferral of taxes. That's an advantage side, right? Taxes are payable only when the pension income is received, and no taxes are payable on the money contributed to the plan either by the employee, and for the employer also it becomes very much deductible. So that's where going with the pension plan is always a good option. But at the same time, you could clearly see whether the company has to go with a defined benefit pension plan or a defined contribution pension plan needs to be decided based on the advantages and disadvantages and the risks associated with each of these plans. So this is what I wanted to cover as a part of this session. I think we have looked at in great detail all these topics that I have highlighted out here. I hope you got a good amount of understanding on all these various aspects of insurance and pension plans. In case you have further queries regarding the same, you can very well get in touch with me by giving me a call on the number that I have provided below, or you can even send in an email at this particular email address. Thanks a lot for listening to this session. Thank you very much.